Narendra Modi has been India's Prime Minister since May 2014. As of early 2026, that's nearly 12 years in office, now into a third consecutive term. If you include his earlier tenure as Chief Minister of Gujarat, he's crossed 8,900 days in uninterrupted elected executive power. That makes him the longest-serving head of government in India's history. That kind of continuity is rare, and it leaves a clear economic footprint. So what exactly is Modinomics? At its core, it's a mix of bold reforms, heavy state-led investment, digital infrastructure, and a gradual push towards self-reliance. Some policies aim to modernize and formalize the economy. Others tried to reshape how India produces, trades, and grows. Many worked, at least on paper. Some came with real costs. Let's start with the most disruptive move. In November 2016, India effectively erased most of its cash overnight. The government invalidated 500 rupees and 1,000 rupees notes, about 86% of all currency in circulation. The goals were ambitious: eliminate black money, stop counterfeit currency, and push India toward a more transparent digital economy. What followed was chaos. Cash shortages rippled across the country. Small businesses stalled, agriculture slowed, and daily wage workers were hit hardest. Growth took a noticeable dip in the following quarters, and millions of jobs were affected in cash-dependent sectors. And the headline result? Over 99% of the invalidated cash eventually returned to the banking system. So the black money target didn't land the way it was intended. But something else did. Demonetization forced a behavioral shift. Digital payments surged, not temporarily, but structurally. It was messy, painful, and controversial, but it accelerated a transition that might otherwise have taken years. Then came GST in 2017. India replaced a tangled web of state and central taxes with a single national system, the goods and services tax. The idea was simple: one country, one market. The rollout was anything but smooth. Multiple tax slabs, constant rule changes, and heavy compliance requirements created serious friction, especially for small businesses. Working capital got locked up. Systems struggled to keep up. But over time, the machine started to work. Tax collections stabilized and then grew. More businesses entered the formal system. Interstate logistics improved as checkpoints disappeared. It didn't simplify everything, but it did standardize a previously fragmented system. Alongside these reforms, the government pushed manufacturing. Make in India aimed to turn the country into a global production hub. Later, production-linked incentives, POMOY, added direct financial incentives for companies to manufacture locally, especially in sectors like electronics, pharmaceuticals, and automotive. There were visible wins. Smartphone production ramped up. Global supply chains began shifting small pieces of manufacturing into India. But the bigger picture is more complicated. Manufacturing's share of GDP has remained stuck around 15 to 17%. The hoped-for surge toward 25% hasn't materialized, and much of the growth has been capital-heavy, not the job-creating engine policymakers were aiming for. After 2020, the strategy evolved again. Self-reliance became a central theme, not isolation but selective protection. Higher import duties in some sectors, incentives for domestic production, and a focus on supply chain resilience after pandemic disruptions. At the same time, something quietly transformative was happening in the background. India built one of the most advanced digital public infrastructures in the world. Millions of bank accounts were opened. Aadhaar enabled identity verification at scale, and UPI, the real game changer, turned smartphones into payment systems. By 2026, the numbers are staggering. Tens of billions of transactions every month, with daily volumes reaching hundreds of millions. What used to be a cash-heavy economy now runs in large part on instant digital payments. This isn't just convenience, it's structural. Government subsidies now flow directly into bank accounts. Leakages have dropped. More people are visible in the financial system. The economy, step by step, has become more formal. Then there's infrastructure, roads, railways, ports, airports. Year after year, capital spending has scaled up. The logic is straightforward. Lower logistics costs, improve connectivity, and make private investment more viable over time. You can see the results physically. Highways expanding, freight corridors taking shape, faster trains, modernized airports. It's one of the clearest areas where policy has translated into tangible change. Zooming out, what does the scoreboard look like? India is now one of the largest economies in the world, climbing from around 10th place in 2014 to roughly 4th by 2026, depending on exchange rates. Tax compliance has improved. Banks are healthier after cleaning up bad loans, and the digital ecosystem is arguably a global benchmark. But the gaps are just as important. Job creation hasn't kept pace with expectations, especially formal, stable employment. Much of the growth has been uneven, with larger organized sectors recovering faster than smaller businesses. Private investment has been cautious, leaving the government to carry much of the growth burden through spending. And then there's inequality. Questions remain about consumption at the lower end of the income spectrum, household savings, and whether growth is spreading widely enough across the population. Some critics also point to the difficulty of measuring an economy as vast and informal as India's, suggesting that headline numbers may not always capture the full picture. So what's the takeaway? Modi's economic era has been defined by scale and ambition, big moves, structural changes, a clear push toward formalization, digitization, and infrastructure-led growth. The economy today is larger, more connected, and more digitally integrated than it was a decade ago. But the hardest part is still ahead. Turning that foundation into broad-based job creation, stronger private investment, and globally competitive manufacturing. That's the next chapter. Because in the end, economic transformations aren't judged just by how fast an economy grows, but by how widely that growth is felt.